Hi, everybody. Okay, nobody's here yet. I had a few little glitches this morning to start, or afternoon now, when we started. We're doing a little something different today with our exam study session. We are doing a on-air, Google on-air. We've done Google Hangouts before for the last one, and the difference is that this one can be recorded. It's a live broadcast, but it can be recorded, and then if you couldn't make it today, then you could, I can post it for you, and go to YouTube, I can post the link, and you can watch it later. So if we have anybody, nobody's here yet, but if we have anybody, then you can watch and see all of our interactions and questions and anything I answer and we talk about and discuss. And if nobody shows up, you can hear me blather for a few minutes. And then I'll just talk about a few things, I guess, and then end this. And you may want to watch me blather later or not. So up to you. So we'll just kind of hang out for a bit and see if anybody jumps in here. This might not be a good time. I tried this time to give you a different time frame than last time in case somebody wanted to use kind of like their lunch break, or if that would be more convenient for someone that when our other time wasn't convenient. So I like to switch my times up just so it gives everybody several options of times and different days that you might be available. But again, that's a good thing about this on air whenever we do these, if this works well. So give me some feedback on it, even if it's just me talking for a little bit, so you can tell me how the feed works, if it's accessible, if the audio and video are okay. So that if this is okay and good, then I can do the study sessions like this from now on, and regardless of what time they occur, you can watch them later. Okay? So again, I had a little snafu with it earlier, so I had to push it back and refresh the link and get something else going so I could get it all set up. So we might have some people join in. If nobody joins in, then two things will happen. One, I will know that this is not a good time frame for everybody. And two will be that I will just kind of give you a brief outline of the chapter topics and content. And then from that, you can, if you have questions, you can email me or post or both or either in preparation for the exam. So instead of just giving you dead time, I'm just going to continue to talk. I'm good at that. The exam it opens on the 22nd. Let me double check. I've got a couple of exams. Oop, hang on. I have a couple of exams opening, so I don't want to get the wrong date for our class. All right, so opens, on the 22nd. So tomorrow at 11 a.m. and closes on the 25th at 11 a.m. Hopefully you already have your Proctor U appointment. That's really important to do early, especially if you have scheduling issues, so that you can get the exact time and date that you need. So Proctor U at the beginning, it takes about 2 weeks at the beginning of the semester, and they have all of our schedules for exams for the whole semester. So at the beginning of the semester, you can actually schedule your exams up front if you wanted to. But regardless, you can schedule those very early within the semester. So I would, sorry, we have a little work being done around here, so you may see some people in and out. But regardless, you can schedule those early. So I would definitely suggest doing that. So this exam, we've got 2 chapters that's on the exam, chapters 4 and 5. So what I'll do, unless somebody just pops in here, I'm just going to kind of go through. I'm going to take our text and open it up. And I'm just going to go through a brief outline of what these chapters talked about, discussed, what you should know for each of these chapters. Okay? So in chapter 4, that's our income statement chapter. Okay, so all of these things, they take what we've known before in 2101, and it builds upon that. So you should already be familiar with an income statement, but this goes into some more depth that you didn't have in 2101. So it starts out and it talks about what the income statement is, the usefulness of the income statement, kind of what the numbers mean, and also some different limitations of the income statement. So it kind of covers that up front. And then after that, we've got your quality of earnings. So it talks a little bit about some earnings management topics, gives you some insight on that and what quality of earnings mean. Then it goes back into the format of the income statement, which you should be familiar with, again, from 2101. So you start with, again, you can do a multi-step or a single-step income statement. We learned about that in 2101. If you have your, ooh, never good, yawning. Once it starts, you can't stop it. But the income statements that you saw in this chapter, I think predominantly, well, no, we saw some single steps too. A condensed income statement is another way to talk about it, like a single step where you put it into condensed pieces. It's not necessarily the same terminology, but it looks similar. So you've got your revenues, you've got your expenses, then they throw in different gains and losses in there, and that's kind of your basic, but then we added on to that. So again, you should remember from 2101, just your basic on, sales, cost of goods sold, gross profit, and then you go into all of your operating expenses, selling and administrative expenses, and then you go into, that gives you your income from operations. And then if you've got any types of other revenues and losses, then you're going to list other revenues, other expenses, the revenues, other expenses down there to get your net income, calculate your earnings per share, earnings per common share. And then your book talks about how you can condense that and do just single line items instead of listing out all your details. For example, your administrative expenses. If you didn't want to list all 30 of those, you can add them up and do it on a single line. Administrative expenses and the total out there. Okay, you can condense it or make it into single line items. Then you can provide notes in the financials with all of the detail that you would have had on a multi-step or a very detailed income statement. So it talks about the multi-step, it talks about the single step. Now the single step is different again than the condensed. They're both single lines, but the ordering is different. In a condensed, it's just like a multi-step, but you just do one line. You do summaries for each category or type. On the single step, you list all the revenues first, and then you list all the expenses and get net income. So you don't have a gross profit, for example, if you have a sales business or a merchandising business. So that's different. It's a different format, a different look, a different ordering of what's on your income statement. So it's different. Single step and condensed are not the same thing, okay? So then we went into some items you didn't see in 2101, which were unusual gains and losses. We dealt with discontinued operations, extraordinary items, and then a non-controlling interest. So we touched on each of those. With unusual gains and losses, sometimes students get confused with those and extraordinary losses. So for unusual, it has to be infrequent in nature or unusual in occurrence, but extraordinary, it has to be both of those together. So maybe that helps you give a little bit of a distinction between the two. Discontinued operations is pretty straightforward. When you do unusual gains and losses, with those, that's included above that operating income line. The others are below, so we're going to have to net out a tax effect for those. So when you do discontinued or you have an extraordinary item, you're going to have those below. And I told you once it starts, it's not good. And then your non-controlling interest. If you own a majority share, so if you own, say, 40% of a company or 70% of a company, you have to consolidate your financial statements together with those baby companies that you own. You're the parent, they're the subsidiary. And so when you consolidate, if you don't own 100% though, you need to show which piece is not yours, the non-controlling interest. Sorry for the beep. And so you'll split that part out and show the difference there. You'll see that on your earnings per share. You'll have the total, and then you'll have an amount that you take out for the non-controlling interest piece that shows how much is not yours or not attributable to your shareholders based on the non-controlling interest part of that. Okay, and they give you several examples in here on each of these, how to calculate. Well, you're going to calculate the tax effect and take that into account for each of the discontinued and extraordinary items. You're going to have to net those out. And they give you, oh my gracious, I'm so sorry. They give you a nice little summary there. I'm trying to find the exhibit. I found it 4-17. Gives you a little chart and shows you kind of just the quick differences between those different types of items that you'd find. A description of them and some examples and the treatment of each one. So that's a good easy, quick reference for you. And if you are forgetting earnings per share, it's a very easy calculation. You just take your net income, you subtract out preferred dividends, and you're going to divide it by your common shares, and we use a weighted common shares. I got that formula for you as well in there. Very easy to know, not super hard for that. But when you have all of these different items, like if you had discontinued operations, if you had extraordinary items, you're going to not only net out those tax effects, but when you get to the earnings per share, you're going to have a bigger EPS section. You're going to have it divided up by those areas. So instead of just having one earnings per share, you're going to have multiple. So again, I think your book gives you one with all of them. You might have a company that only has, say, an extraordinary item or discontinued operation. But you start with income from continuing operations, if that's the case, if you have some of those special items, and then go down from there. So if you had income from continuing operations and an extraordinary item, and then your net income at the bottom, you'll have EPS for each of those subdivisions, okay, or subcategories. So you show how the earnings per share changes with each of those, okay? And if you want to see that again, it's illustration 4-19 has a good example. And I think it actually has all of those special items there. So you can see how it would look if you had every single one and what your earnings per share would look like. And then it goes through a couple of other reporting issues. And we may have touched on, say, change in accounting estimates in 2101. But this just goes into more detail on some changes or some errors that may be made and how we account for those. So they give you three: change in accounting principle, change in accounting estimate, and error or correction or any kind of boo-boo that you might find. So if you're changing an actual accounting principle, and again, we're talking about things that are legal, that are GAAP, but you're changing from one principle to the other. The one that most frequently you see is change in inventory valuation. So let's say you were using average and now you're going to LIFO, or you were on LIFO and you're going to FIFO. I don't know. You can't do that back and forth all the time, but let's say that you've decided that you need to do that for the company. What you're going to do for that is you're going to go back and retroactively restate all of your financial statements from forever and 2,000 years ago, whenever it impacts, all the way up to now. So you're going to go back and change all of those past financials to reflect how this would have looked had you started it from whenever it needs to begin. If you for inventory, maybe, the first year you had inventory. But you're going to restate those prior years' financials to reflect that new change. Now, if you're just changing an estimate, non-accounting principle, so depreciation is the one I think of with this. You're changing how many the useful life, how many years on a piece of equipment that you're depreciating. You're not going to go back and restate all of your financials for that. What you're going to do is you're going to change that in today and going forward. So we're not going to go back and restate financials. We're not going to do any of that. We're just going to go do this now and go forward from here. So you're going to show that if you have affected accounts now and then in future periods. And if you have to, you're going to net out tax for both of the ones I've already talked about, the accounting estimate and also your accounting principle. Then your error, so you find something that's wrong. Trying to hold it in. You find something that's wrong. With that one, you need to fix the problem, but you're going to treat it as what we call prior period adjustment. And when we do that, it restates the prior year's income to correct that error. But when you do prior period adjustment, you take the adjustment to retained earnings. So you're going to adjust it through retained earnings. So you can restate those, but we're not going to retroactively restate. We're not going to go back and fix it and then carry it forward just like it had always existed. We're going to say, okay, it's a prior period adjustment. We're going to, decrease retained earnings or increase however it affects retained earnings, and whatever the other side of that equation is. If it was, you found it in office supplies or office expense, whatever it is, the other side of that, it wouldn't be office expense. That would be the retained earnings side. But let's say it was, in some other balance sheet account, and the other side of that would go through retained earnings. Whatever would have passed through on the income statement will go to that, either an increase or a decrease. Again, we show that net of tax effects. And there's also another little figure. 4-22 that gives you a brief summary on those 3 types of corrections or errors that you may find and how you would account for those. Again, you're not going to make an entry for the first, the change in the accounting principle. That one we're going to go back and restate all the financial statements. The other 2, the second one, you're going to make an entry today for whatever it affects and go forward. The third one, you're going to make the adjustment to retained earnings now for those prior periods so that it's fixed today, pretty much. Okay, but look at that little table. Gives you a good little summary of that one. Okay, what else here? It talked about appropriated retained earnings. Read that. If you restrict your, you're restricting your retained earnings for any reason, then it will show an unrestricted portion and a restricted portion of that. Okay, so again, most of the time that's a contractual arrangement, or the board of directors could restrict that for some reason, and that'll affect how much you can pay in dividends. So you can't take it out of restricted retained earnings unless that's the reason you restricted it for some reason. Okay, then comprehensive income and other comprehensive income. Talked about that. Comprehensive income is everything. It's all your regular retained net income plus the other stuff. But other comprehensive income are items that affect comprehensive income, but they don't flow through your income statement or your, lost my word, they don't flow through your income statement like they normally would, so they're not going to pull into that to go through retained earnings like you'd normally see. So usually the item that you see the most, there's not a whole lot that would go through other comprehensive income. That would be unrealized gains and losses, holding gains and losses on holding investments. That's the one you're going to see the most often. And the text walks you through, and there's not a whole lot of other comp income items, but it's something that's recorded that's not shown on the income statement. It has some kind of a workaround or a bypass through to that. So we include it in those items. Now, you could display this in different ways, and the text talks about that. You can do it all in one statement. So you can have a statement of comprehensive income and have all your net income, your regular income statement, and then you tack on that other comprehensive income at the bottom to get total comprehensive income. You can do it as a separate statement in addition to an income statement. So you run a regular income statement just like you normally would, and then you also do a comprehensive income statement. So you take that, and again, you add on, you've got net income, and then other comp for total comprehensive income. You can also do a statement of stockholders' equity. Don't confuse this with a statement of retained earnings. They're not the same thing. Statement of stockholders' equity is going to show every account that's part of stockholders' equity, the changes in that account over that period of time, and then the ending balance, the beginning changes, ending balance. So you'll have a total, you'll have retained earnings and all the changes in that account, you'll have the other comprehensive income, and then you'll have, like if you have common stock, preferred stock, you'll have a column for each of those as well to show all the changes for each of those. And then your balance sheet presentation, you'll have an accumulated other comprehensive income item there. Otherwise, you won't be able to balance because it's not in the income statement. It doesn't go through retained earnings. So you'll add that onto your balance sheet as well so that you can balance. All right, that's a brief overview of all the topics that we covered in Chapter 4. Okay, now for Chapter 5, we move on to the other financial statements, or 2 of them at least. Let me flip so I can kind of go along with the topic list for that one. All right, Chapter 5, balance sheet and cash flows. So I'm not spending much time on, retained earnings or stockholders' equity. We kind of touched on those just a little bit with the income statement. Again, it talks about uses and limitations of a balance sheet, things you'll find, things you can use for analysis as well. And then for this balance sheet, we talk about a classified balance sheet. Again, in Accounting 2101, you had a balance sheet, and we did talk about a classified. We talk about how you can have it in report form or account form. Account form is where you have, let's try and mirror this. I don't know if this makes sense to you. See, that makes sense to me, but I don't know. Anyway, I'm just trying to show you the account form, but where your assets are going to be on the left, your liabilities and equities are going to be on the right, and both sides balance, just like an account would. Your left and your right have to balance. Or you can do report form, and that's where it just all flows top to bottom. Accounts listed first, assets listed first, then liabilities, then your stockholders' equity. Okay, and the total assets have to equal total liabilities and equities, but it's all in a report form flows from top to bottom. So we talk about that in 2101. A classified balance sheet adds in subcategories to your basic balance sheet. So instead of just having assets, liabilities, and equity, you have multiple areas for each of those, or subcategories. So you have current assets, you have investments, you have property, plant, equipment. For current, you have current assets and long-term. Current liabilities and long-term liabilities. That one's pretty easy. And then your equities. So assets really is the one that changes the most with this. Liabilities we split into two. But again, for the most part, assets takes the most of the change. So as your textbook goes through, and first it kind of gives you some examples of different assets in each category. So for current assets, it tells you about cash and cash equivalents, short-term investments, receivables, inventories, prepaids. We've talked about all these before, and you've seen them, but it's just showing you where these go and some more details on each of these. And it also gives you some examples of notes that you would see with this, because in the notes to the financials, we provide the users of the financial statements with much more detail than just here's receivables and here's the amount. We tell them some more information about those. Okay, so look through that's what you would really see if you looked at some financial statements of a company, especially a publicly traded company. Talks about different types of investment, held to maturity, trading, securities available for sale. So again, it takes you through and gives you examples of each of those types of categories in the assets. Current investments, property, plant, equipment. You can have I think I even talk about long-term investments in there, non-current assets. But non-current assets includes a lot. So you'd have things like long-term investments, property, plant, equipment. You could have intangible assets. So all those would be included there. So they give you examples of each of those. Again, for liabilities, you're just dividing it into current or long-term. So it depends on when it's expected to be paid. Within a year, current, further, long-term. Now, one little tricky thing is the current portion of long-term debt. So if you have a note that's due and it's a 20-year loan, but you pay it in annual installments, you're going to pay one of those within the next year. So that one payment needs to be included in the current liabilities. The rest of it needs to be in long-term. So make sure you look at distinctions for that. We talk about some ratios throughout these, like working capital, some ways you can use the information for analysis and figure out some different things with this. And then you have your stockholders' equity or your owner's equity, depending on the type of business that you have or the organization style. So you could have retained earnings there, common stock, preferred stock. You could have that accumulated other comprehensive income if you have that. You could have treasury stock. So non-controlling interests, if we have any of those that we talked about before. So you'd find those types of things in your equity section. Okay, pretty much the same. So they give you an example of a very long report form in example 5-16, exhibit, illustration, however you want to say it. So it shows you all the different little pieces of the classified balance sheet. So you can see a good example of that one there. And then it goes into the statement of cash flows. Hopefully you touched on statement of cash flows in your 2101 course. If not, and this is brand new, don't feel bad. Sometimes cash flow takes a little time to get, but you should have already been practicing with this. And repetition is key with this. You need to practice over and over and over. And then if you're not getting it, cash flow is one of those that you really need to put some time to it for it to make sense. And feel free to ask me questions. I can help as much as possible to try to make it a little easier for you, okay? But with the cash flow statement, we are tracking cash. That's the whole point of the cash flow. I want to know where the cash is coming from. So, excuse me. It's got 3 sections, and I think in my video I gave you my cheesy little acronym for it. O, it flows. Cash flow. O, it flows. O, operating. I, investing. F, financing. If you haven't watched my video, check it out. I think I say that one in there too. It's a little cheesy, but it's a good way to remember what order the 3 sections go in if you can't remember. The operating section is the most complicated. Investing and financing are pretty straightforward. So investing, we're talking about buying or selling investments, buying or selling property, plant, equipment. So long-lived assets are going to go there. Buy a piece of land. Did you pay cash for it? If you did, how much? and it goes in investing as a deduction. So I want to know where the cash is. For financing, then you're talking about long-term liabilities, equity accounts, you pay dividends, you issue bonds, have a long-term note, all of those. And again, the cash part of them, be careful. This is tracking cash. This is the only time I tell you don't do accrual, because we want to convert things over to a cash basis. So if you declare dividends, but you didn't pay them yet, they're not going to show up on the cash flow statement. Okay, not here at least, not in that section. So you have to be careful that you know how much of this is cash, because that's what we're looking for. Okay. Operating section, I say, is the most confusing because there's two ways to do it. There's a direct method and an indirect method. The large majority of companies use the indirect method, and what the indirect method is that we're going to take net income off the income statement, and I want to adjust it to a cash figure. Okay, so it's not a cash figure, it's an accrual figure. So I've got to be able to take that and convert it to a cash basis. So I think, I don't want to bore you, I think I give you a good explanation of this in my videos on cash flow 1 and 2. So look those over if you haven't. If I don't go into as much detail, I can talk about this for a long time and give you lots of examples. So if I need to do that, I can. Just let me know, okay? So for now, I'll wait. I think I've got those details in the videos, okay? So look through that, look at how you adjust net income, and I will say that the easiest way to remember on the operating section is that you need to remember kind of the things that you adjust. There's 4 adjustments. There's gains, losses, depreciation, and amortization. Depreciation and amortization get added back. They don't have anything to do with cash, but they deduct from the net income figure, and we're trying to make it cash basis. So we need to add them back. They deducted from that account, but they didn't have anything to do with cash. Then you've got gains and losses. A gain originally added to net income, but it didn't have anything to do with cash. And a loss originally deducted from net income, but it didn't have anything to do with cash. So we want to deduct gains, add losses back. Then we get to current liabilities and current assets. And for those, you're going to probably be best off to just memorize what you do with each one. So for current assets, you're going to do the opposite. And for current liabilities, you're going to do the same. So for instance, if your account receivable went up, you need to deduct the change. If your current liability went up, you would add it. And I know that sounds really confusing, but it's probably best for you to just memorize that instead of try to make sense of each type of account. Now, I can make sense for them for you, especially accounts receivable is probably the easiest one that makes sense to people. So let me give you an explanation on that one. And I'll also give you an explanation of something that can have a double impact on the cash flow statement that sometimes gets tricky. So I'll give you 2 examples of that. So the first thing is, let's talk about this receivable. So we have an account receivable, and we increased the account over the year. It went up from last year. Well, think about when you make an account receivable entry. You increase accounts receivable because someone owes you money because you provided services or goods for them. Well, if you provided goods or services, your revenue went up, your income statement, your income went up, and your account receivable, an asset, went up. But have you got any cash for it yet? No. And remember, what we're trying to do is take net income and adjust it to get it to a cash basis. So if we increase sales, but we haven't got any cash because it's all in receivables and I'm waiting to get the cash, we need to deduct that increase. That help a little bit? Again, each account might not make sense to you, but I can make sense of it, but it's probably just easiest to memorize those kind of rules, or what I say are rules for that. You do the opposite for the current asset change, you do the same for the current liability change. 4, give you 2 that might be kind of tricky. They might make sense, they might not. Let's say that you had a piece of, let's say you had a piece of equipment that you sell, and you had the equipment and the book value was, I don't know, $10,000, and you sold it for $12,000. How much cash did you get? And we sold it for cash. Be careful with that too. What if you sold it and somebody owes you money for it? They give you a note, or they exchange stock. you didn't get any cash, so you don't record that, okay? You record that as a non-cash transaction at the bottom, so we'd know about it, but it didn't have anything to do with cash. So you sell a piece of equipment, $10,000 book value for $12,000. You got $12,000 in cash, so that, because it's equipment, property, plant, and equipment, it's in the investing section. So you'd increase the investing section, $12,000. But you had a gain on the sale. You had a book value of 10, you sold it for 12. So the $2,000 gain is included in your income statement, your net income amount. But the $2,000 didn't have anything to do with cash. We already recorded the 12. So if you left the 2 in there, it would be like you double counted a piece of it. You didn't record the 10 and the 2 somewhere else. You recorded the 12 because that's how much cash you actually got. So the $2,000 that's in income doesn't have anything to do with cash. You already recorded the cash in that other spot. So we need to take the 2 out of there. We need to deduct that gain back out. Another one that might be odd would be dividends payable. And I mentioned this one a little bit before. So if you declared dividends, but you haven't paid them yet, then you increase that dividends payable account. And if it's a current liability, then you'd see that change and go, well, so there's a change in this. Well, you need to be careful with that to actually see how much your dividends that you paid, because the payment part is going to go in your financing if you've actually paid dividends. Now, if the dividends payable account just changed, okay, again, be careful. It doesn't necessarily mean you paid cash. It could be that you just declared the dividend. So you want to, again, be careful with that one, okay? So let me think. Anything else I can think of off the top of my head? Those 2 are kind of tricky, just a little bit. Look through the examples again. Pull the videos up. Make sure you've got questions after you watch those. Let me know. And look through those illustrations on cash flow, and you can see those non-cash transactions listed at the bottom as well. Like, again, if I said we sold that piece of equipment, but we exchanged the equipment for stock, it was a non-cash transaction. But you're going to see that equipment's impacted on your account, and so would your investments if you held those securities for investments. So we would explain that change down in that non-cash activity item to say, hey, we know this changed, but here's why. I didn't have anything to do with cash. So you'd want to disclose that as well, okay? We've, again, got some liquidity analysis that you can look at with like free cash flow and financial liquidity measures. And then the end of this chapter, we wrap up with talking about contingencies and some other disclosures about fair value or contractual situations and how we could disclose those on multiple different items and types of disclosures. Okay? All right, I think that's about everything. And obviously this is not the best time for y'all to come and do study sessions. So next time we'll flip it back to the night because we had a lot more people come during the night than we did during the day. But I'll still post this for a little summary for you. Look back through it, look at the videos on there, and then give me any questions you might have. All right, guys, I will talk with you later. Trying to think of anything else I can think of to tell you. But I think that's pretty much it. Okay, so give me your questions, give me your feedback, and even though we didn't have anyone in here for a nice live session, if you check this out, give me some feedback on whether this was good, bad, indifferent, how the quality was, and we can do this one for our next, so it can get posted for anyone who can't see or can't be at the meeting. Okay? Thanks so much, guys. Bye.